Hello everyone. I will cover chapter 4 in this lecture. This chapter is about enterprise risk management, and these are some of the concepts that we will cover in this chapter. In the previous chapter, we looked at risk management. This was related to pure risk, that is, events which lead to loss or no loss. But we see that the company is exposed to both pure and speculative risk. Speculative risk is where the company may face profit or loss. So the risk manager's work has expanded. It is no longer related to finalizing insurance contracts, but they also have to consider pure and speculative risk. And they have to consider all risk exposures of the organization so that the company can function properly. So to help risk managers in this process, we have enterprise risk management. It tries to address the full spectrum of a company's risk through an integrated portfolio. So what is enterprise risk management in a nutshell? It covers all areas of an organization's exposure to risk. It prioritizes risk and manages them in a portfolio approach. It also recognizes that different risks are interrelated, as are different investments within the portfolio. So it helps to give a structured process and effective management for risk within the organization. So these are the important steps in enterprise risk management. It starts with risk identification, then risk analysis, then selection of risk treatment measures, and finally monitoring or programming changes if required. So enterprise risk management is used by many large organizations, and hence there might be certain resistance to change in certain departments of an organization. For successful implementation, the company requires the buy-in from all concerned, top management as well as different departments. So what are some of the different risks that enterprise risk management considers? The first is hazard risk, that is property risk, liability risk, and personal risk. Then there is financial risk, which is due to the changing value of financial assets, interest rates, and so on. Operation risk is related to the company's business. Strategic risk is related to the company's business decision and their consequences. Compliance risk is related to non-compliance with laws and regulations. So these are some typical risks that a company may face and their categorization as well as an analysis of their impact. So the first step is to identify the risk. What are the different types of risk that we have covered in the previous slides? The next step is to classify those risks in a 2x2 grid. The two grids are frequency and severity of loss. That leads to a risk map. So we have different risk exposures and they are mapped to a 2x2 coordinate of severity and frequency. The next step is to assign risk score. It is a qualitative or quantitative measure denote importance of each risk exposure. Now, based on that, the company will select different risk treatment measures. Some of the risk treatment measures we have already covered in the previous chapter. There are additional measures which are relevant from the perspective of enterprise risk management. So before moving to those risk management techniques, we need to understand these two concepts. The first is risk appetite. It's the total exposure that an organization is willing to accept. And risk tolerance is the amount of uncertainty that an organization is willing to accept. Based on that, the company will decide how much risk to retain, how much risk to uh, cover through insurance or other techniques. So that will depend on the risk appetite and the risk tolerance of the organization. Because there is financial risk, there are certain special techniques which are employed. One is diversification, that is investing in different assets like savings, bonds, stock market, and so on. Then using market orders, using options and future contracts. So we'll look at some of them in detail in this. For some other type of risk, it is important to coordinate with the concerned department to understand the risk better and hence adopt a suitable technique. What are some of the benefits of enterprise risk management? Increased risk awareness, increased certainty of meeting the business objectives, increased compliance with regulations and laws, greater accountability and greater efficiency within the organization, and so. Now, it is also important to understand the insurance market because some of the risk management techniques pertain to insurance, and the risk manager has to deal with insurance companies in this regard. So the insurance market goes through cycles. Hard market means insurance companies impose stringent norms, stringent conditions, and they charge higher premiums. Whereas when the cycle is going through soft markets, they have less stringent terms and conditions to provide insurance cover, and they charge less premiums to their clients. One indicator of the insurance market is the combined ratio. So here, if you notice, the numerator has all the expenses or all cash outflows, and the denominator has cash inflows. So this gives us an idea of cash outflow to cash inflow in the insurance market. If the combined ratio is more than 1 or if it is more than 100%, then the insurance companies or the insurance market in general is not profitable. So based on this understanding, you can find out what would be the combined ratio in a hard market and what would be the combined ratio in a soft market. So this graph shows the combined ratio at different years, but in the US insurance industry, or rather certain segments of the US insurance industry. Then we look at other aspects of the insurance market. That is called capacity. Capacity refers to the relative level of surplus. Surplus at the insurance company level means the difference between the insurance company's assets and its liability. Ideally, assets should be higher than the liability. To increase the surplus, many companies engage in investment so that they can earn higher returns and increase their assets and hence the surplus. But in some instances, several insurance segments may suffer large losses at the same time. So that leads to the case of flash loss. Also, we see an emerging trend in the insurance industry. Both companies as well as insurance companies, they are trying to use the capital markets to manage risk. One way is securitization of risk. In this case, an insurable risk is transferred to the capital markets through creation of a financial instrument. For example, the financial instrument would be such that if a loss event occurs, then there would be certain payouts to the company, or there could be restructuring of the payouts to the company. And insurance option depends on an underlying value. Let's say uh, a loss event occurs, and then the company will receive a payout. That is how a typical insurance option is structured. So catastrophe bond is one example of securitization of risk, and we see that there is an increased acceptance of catastrophe bond in the US market. I'll stop here and I'll continue with the rest of chapter 4 in the next lecture. Thank you.